Welcome back to Finance Desk. So it has been a while from the last impromptu video. If you haven't watched that one, I'll give you a link in the I button. You can watch that after watching this video. A lot of things have changed from the last video. First, the Iran war doesn't seem to end and we have got multiple hikes in petrol price and the import duty in gold has been increased and PM came out and said not to buy gold and to avoid foreign travel. You might have already watched multiple videos on arguing whether what PM said is right or wrong. I'm not going to bore you with the details of that. The main purpose of this video is to tell you why I tripled my SIP in gold despite PM telling not to buy gold. So before going to the reasoning, right, let us first see the gold cycle. So I'm here in trading view. I opened gold slash INR, that is gold in rupee chart, and I have enabled monthly time frame. So if you see the gold chart from 1973, right, you will see gold moving in cycles like you can see, right, from 1973 to 1988 it moved sideways, then there was a rally, then again it moved sideways followed by another stellar rally and a prolonged muteness. Like from 2011 to 2023 you will see gold moving sideways again and a small up move, then again sideways, and now the rally we see today. So gold moves in 6 to 9 years cycles. So when you are investing in gold you should be aware of this. Now the gold has already rallied a lot and to be honest, right, I don't know whether it is going to rally or going to go sideways. At least according to the chart, right, it should start moving sideways in a year or so. Now with this, right, it's very difficult to understand what is the return expectation from gold. You might have seen gold giving like 100-200% returns in the past year or two, but you have to be realistic, right? You'll have to hold gold during periods like this for decades together. So let us first understand what is the realistic return expectation from gold. For that I was searching for different tools, but I couldn't find any tools which will give you the SIP returns of gold. I think the gold mutual funds, so whatever ETFs we have, right, that was launched like 10-13 years ago only. We don't have long historical data where I can calculate the SIP returns. So that is where I built a tool. So if you know, right, FinanceDeft is my website. So you can go to financedeft.com and you can hover over tools and you will see compare assets. This will compare returns of different asset classes like gold, equity, and so on. So by default, you will see gold, Nasdaq, and Nifty 50 comparison. And of course, we know that Nifty 50 has been underperforming from a while and gold has been outperforming all the other asset classes. So you will get the different options here like trailing returns, SIP returns, range returns. You can go ahead and explore it after watching this video. And of course, if you go to any time frame, right, you will see gold outperforming other asset classes. So if I go to like 30 years also, you will see gold as giving 12% returns where Nasdaq and Nifty has given only 10% returns. Of course, Nasdaq is in US dollars. The rupee has been depreciating like anything. So you can compare that as well here. So if I search for INR, right, you will find USD INR. So if you see 30-year time frame, right, the rupee has been depreciating 3.4% annually. So when you're comparing Nifty 50 and Nasdaq returns, right, you will have to consider the rupee depreciation as well. So that basically adds up to the returns. Of course, we cannot directly add these two and find out the returns because the compounding doesn't work like that. First you have to add and then do the compounding. If you compound and then add, you'll get slightly lesser returns, but that is still fine. You can get an idea on what kind of returns you can expect. And one thing to note here, right, so as we have seen, right, in every time frame the gold has outperformed other asset classes. But is that really true? Let us go to custom and try to find gold returns till 2024. So if you see here, right, from 1990 to 2024 gold has underperformed the other asset classes. It did not outperform. So only because of the returns in the last 2 years, right, you will see that the gold has outperformed all the other asset classes. So you can't blindly invest in gold and say that it is going to beat the markets or the other asset classes all the time. You can change the start time as well here. I'll keep increasing the year and you can see the gold returns and compare it with the other equity classes. So if you see, right, most of the time the gold has given anywhere returns from 9 to 10%, and it is not fair just to check the trailing returns because it gives returns from one point to another. And as they say, right, if you have enough data points you can connect any 2 points and tell a convincing story. To avoid that cherry picking, right, let us go to SIP returns. So while calculating SIP returns, right, you will take input or you will take the investments every month. So you cannot just say that I picked random 2 data points from the chart and proved my point. Here also you can check different time ranges and you can pick the custom range as well. So if I do SIP returns for 30 years, right, you will see, of course, the gold has outperformed, and I'll do custom and I'll check till 2024. Yeah, as we have seen, right, you will see around gold has given around 10% returns. And of course, Nifty gives you around 12% returns, which has reduced recently to 11.5 because Nifty has been moving sideways for the last couple of years. You can see the rolling return as well. I'll just remove Nifty and other things here. I'll just keep gold. So if I go to 7 years, right, we have seen gold moves in 6 to 9 year cycles. We cannot select 6 to 9 years here. The closest one we can select is 7 years. So if you see, right, up to 1980, the rolling returns, 7-year rolling returns of gold has been 37%, and which dropped to near 1% in 1987. It again went up until 1993 for 13%. It dropped to near zero in 2001. That is, had you invested in gold on 1994, right, and it would have given you no returns till 2001. And again it rallied till 2012 and the rolling returns went up to 24% in 2012, again dropped in 2019 to almost zero, and now in May 2026, as we have seen, right, gold has given stellar return. So that is the cycle I was talking about in gold, typically 6 to 9 years of cycle. And you can do a comparison as well. Let us say I'll select silver, right, you will see different time period and its comparison, and even yearly returns as well. You can compare it here. And interestingly, we have a risk tab. So what this does, right, usually we invest just seeing the returns, right, we have to analyze the risks as well. So we have got standard deviation. Standard deviation is nothing but how widely the asset class moves. So if you compare gold with silver, right, the standard deviation of gold is 16% and that of silver is almost double. That is, silver moves twice as widely as gold. And sharp and short no should be higher, and I'll not go into the details of that. If you check here, right, gold is better than silver, and beta is how much the asset class fall, and of course silver falls more than gold. And alpha, right, alpha is how much the asset class outperforms the benchmark. Here gold is chosen as the benchmark. If you see, right, just 0.96, that is the only alpha that is generated by silver, and of course that is not worth the volatility silver gives you. So that is why I usually avoid silver and prefer gold. You can choose different time frames, not just 3-year. By default 3-year will be chosen. If you go to any time frame, right, most of the times, like 80 to 90% of the times, you will see gold doing better in terms of risk. So let us come back to Nifty, right. I was comparing SIP returns between gold and Nifty for the last 5 years. As expected, right, the gold has given 35% returns and Nifty has given FD like returns. You might hear a lot of stories or the reasons why the Nifty is underperforming, but what I would say is reason shouldn't really matter. I'll show exactly why. So I have Nifty chart open here. So this is the time period we are talking, right, 2 years of underperformance or 2 years of moving sideways. So if you see the history, right, from October 2010 to January 2014, you will see Nifty has given zero returns. That is for almost 3.5 years. Again, from February 2015 to March 2017, that is like 2 consecutive years, you will see Nifty doing flat. Same thing repeats here as well. From January 2018 to February 2020, again 2 years, the Nifty has done nothing. And even after the COVID rally, right, from October 2011 to almost November 2023, it is just 2% returns. So every 3 to 4 years, right, you will see Nifty doing flat or not performing. So this is not new. This has been happening in the past. It is just that because of this stellar rally after COVID, right, we are seeing some underperformance in Nifty and we are worried what will happen. Will I lose my investments and all those stuff, right? That is just because of this continuous rally. We have never seen this kind of rally in the history, and people are never used to sideways market or the bear market. So you have to understand this bear market or the sideways markets are part and parcel of the game. And coming back to the why part of that, right, I have asked ChatGPT why the Indian market went sideways in these years. So it has given detailed answer. You can go through this or you can ask yourself. So this is what the summary is. Indian market historically alternate between strong bull market and multi-year consolidation phases. As we have seen, we'll see 1 year of strong rally, then couple of years of sideways. That is how the market works. And these are the reasons like valuation reset, earning phase catch up, and sectoral rotation, all different reasons. And each time, right, there will be a different reason. You'll see people saying that this time it is different. Of course, every time it is different because market doesn't fall for the same reason again and again. It is always different every time. And every time people will say, oh, we are done, this is done, India is doomed, or market is doomed. That is not the case. Market will recover. You just need to have the patience. And confirming to what I just said, right? If you check the SIP returns from, let us say, April 2020, that is the bottom of COVID crash, till September 2024, you'll see Nifty has given 21% returns. That is for almost 3.5 years. So if you have started investing after seeing this stellar rally, then of course I can understand you would be disappointed. So don't keep this high expectation with the market. Keep the expectation low. If the market beats your expectation, of course you'll be happy. And coming to US market, right? Of course, similar to gold, the US market has given great returns in the last couple of years, but even US market underperforms. Let us say from 2002 to 2007, right? You will see Nasdaq giving just 11% returns and Nifty giving almost 38% annualized returns. You might ask, Nasdaq is in dollars, Nifty is in rupee, maybe rupee depreciated during that time. Let us check that as well. So if you check USD INR, right, you will see actually rupee did not depreciate, it slightly appreciated. So if you see this, right, Nasdaq didn't even give 10% returns during this period. So the point is, you cannot just concentrate all your asset in one equity or one asset class. So you have to diversify. So that is the first reason why I increased my allocation in gold. Currently, my allocation in gold is less than 4%. I know it is a bit embarrassing. After doing all this video, my asset allocation isn't perfect, but I'm working on that. That is why I increased my allocation on gold, irrespective of gold hitting all-time highs recently. And then it gives you a protection from rupee weakness. So as you might know, right, gold is traded in US dollars. So when you invest in rupee, right, it gives you the USD dollar returns plus the INR depreciation, and it gives some hedge against uncertainty. I wouldn't say gold always moves upward whenever the equity falls. That is a false notion, but it gives you some stability when the market crashes or during uncertain times. So we have seen gold rallying a lot before all this global crisis has started, and I believe all this crisis is going to continue for a while. So equity may underperform in the short term as well. You might ask, why not US equity? Why I didn't increase my SIP in US equity? I already have my SIPs going on is US equity, and 14% of my total net worth is already invested in US equity, and 33% of the total equity, that is one third of my equity portfolio, is in US, and remaining two-thirds is in India. And I'll show how US portfolio has saved me. If you see, right, this is my unrealized gain in percentage, that is 71%. I seriously started investing in US market couple of years ago only, and if you check the INR returns, right, that is 85%. That is 14% more than the dollar returns. That is of course because the rupee has been falling like crazy in the last 2 years. And believe me or not, my Indian portfolio returns is just 50%. I've been investing since 2017. That is over 9 years now, and by investing in US market in the just 2-3 years, I gained more than that. And here is my SIP breakdown. So 12% of my monthly SIP goes to US equity, 20% goes to gold, and remaining 68% goes to Indian equity. Of course, the majority goes to Indian equity. I still believe in Indian equity, and I want some diversification as well. And one more reason why I didn't increase the SIP in US equity, right? I believe US is extremely overvalued, even more overvalued than compared to gold. So that's why I have slightly higher SIP in gold and less in US equity. And I have 3 predictions to make. These predictions are purely based on my gut feeling, and these predictions can be completely contradictory to whatever data or chart shows or whatever I have explained so far. So take it with a pinch of salt. First, I believe AI bubble is not going to crash this year. It is going to crash in 2027 because I believe AI bubble is not big enough to pop. Next is Indian market is going to underperform for the next 3 to 5 years. Yeah, I know I have 67% of my equity portfolio in Indian markets, but I still believe India will outperform in the very long term, like 10 to 15 years. But in the near duration like 3 to 5 years, it is likely to underperform. Multiple reasons. Of course, the global uncertainty, higher crude oil prices, gold prices at all-time high. You can read this article I have written few years back on how the input cost can push inflation. So if you have supply chain issues or increase in oil prices, that will increase in inflation because everything is linked to oil. You might not feel it yet. In the next 6 to 1 year, right, there is going to be huge price hikes. So you'll start feeling that. So that is definitely going to affect the spending and rise in inflation, rise in interest rates. And of course, market doesn't like high interest rates. Then last prediction is there will be an increase in tax for foreign capital gains. So if you see today, right, if you are investing in foreign markets, if you hold for more than 2 years, right, they are considered for long-term capital gains. Because of this, right, a lot of people like you and me have started investing in US markets and all the other foreign markets. And of course, the finance ministry is seeing this. They will try everything to stop people from investing from outside because of course the rupee will weaken, and of course this will be another chance for them to extract more tax from people. So these are the three predictions. Of course, as I said, these are purely based on my gut feeling. There's no data to back this, and don't believe this blindly. And on the closing thought about increasing my investment in gold, isn't it against what PM said? PM requested people not to invest in gold. But of course, in crisis times like this, you have to be a bit selfish. Let us say you're a salary person, right? And you get laid off tomorrow. The severance pay that company will pay you, that is given to you just to survive until you find your next job, right? That is also taxed by the government. So I don't feel any guilty in doing this. So that has been a bit of sweet closing. Hope you all liked this video and found this informative. If you have, please consider subscribing to the channel. I have posted other videos as well in this channel. So go ahead and check that out, and I'll see you in another video.